For Morningstar, I'm Jeremy Glazer. The U.S. budget deficit grew in fiscal 2016. I'm here with Bob Johnson, our Director of Economic Analysis, to see what was driving that and what's projections of what it's going to look like in the future. Bob, thanks for joining me.
Great to be here today.
So let's look at this fiscal 2016 data. Where did the budget deficit come out?
Yeah, we came in at a deficit of $588 billion. When we adjust that number for the Medicare payments, which were double-dipped in 2016. So we're at about $588 billion. And put that in some perspective, that's up from the $435 billion or so the previous year, which was the low of this cycle. And it's now about 3% of GDP versus about 2.5% of GDP. So the deficit has clearly worsened after many years of nice improvement.
So is this a story of spending going up considerably, or is it that less money is being brought in through tax revenue?
Well, you know, the really big problems on the revenue side, but let's talk about the expenses first. They were up about 4.6% year over year, which was actually less than the year before. And the big driver of that was the entitlement programs, or the mandatory programs, if you will, of Social Security, Medicare, Medicaid. And you roll those together, and they were up a fair amount. But the other category was only up 3%. So that was some good news that remained under tight control, largely as defense spending still remains pretty close to zero year over year. So spending was not really the problem.
But if bringing in revenue was, what segments are not doing as well?
Yeah, the corporate tax number looked just awful. I mean, for the full year, corporate tax collections were down 12%. And so that's a pretty big number. And people had thought, this wasn't going to be a great year for collections. But this was kind of truly awful. And, we knew it wasn't, or we all suspected it wouldn't be a great number because they made a bunch of tax law changes. A lot of the credits and so forth that were set to expire in December were eventually renewed at the 11th hour. So people had accrued for those, and they didn't end up having to pay them. So they kind of went as a credit against future tax bills, and that went retroactively. So that certainly hurt the number, and we suspected it would. But we thought we'd kind of lap that phenomena, and that maybe corporate profits would creep up a little bit, and then you combine the two, it wouldn't be quite the disaster that it was. But it didn't. In fact, the September, which is a big collection month for corporate taxes, looked almost as bad as some of the other big collection months of the year. So no improvement on that front yet, which is problematic longer term because it's an important part of the data set.
Is there any prospect of that looking better next year? I know as we enter earnings season, there aren't a lot of, or there isn't a lot of excitement that corporate earnings are going to look much better.
No, we're not in great shape there. And I mean, I think if you look at a lot of the forecasts that are out there, the September quarter is now projected to be another lackluster earnings growth period, especially for the S&P 500. Maybe not as down as much as it was, but the expectations are still for a down year-over-year profit number yet again. So that's a bit of a problem. And certainly we didn't start off the earnings season with a boom. Alcoa certainly kind of laid an egg with their numbers and got us off to a bad start on earnings season.
So looking at individual taxes, capital gains had driven some better numbers there, but that wasn't the case this fiscal year.
That's right. I mean, on the total individual tax collection number, the numbers looked relatively dismal. There was actually no growth in that, which we'll get to why, but overall the number was about zero, and a lot of it related to, as you said, there weren't as many capital gains, so people didn't have to pay taxes on them, and that kind of went away. Small business profits kind of flow through the individual line, the ones that aren't organized as corporations, and certainly that hasn't been a great number either. And kind of some of the bonus type income wasn't as great as it had been. It wasn't disasters, but they weren't as good as they had been. So we had no growth from those sectors, which are often higher earners. It didn't do quite so well with absolutely no growth there. And again, remember, spending was up 4.6, and we got corporate down. We've got total individual flat. So it certainly wasn't a good news story.
But there was at least one bright spot.
There was, and that's the payroll taxes. We've talked about employment growth's been good, not necessarily great, But we've certainly seen some improvement in the number of workers, and we've seen some improvement in hourly wages. And you put those two together, and Joe taxpayers kicked in about 5% more in taxes than a year ago. So that was the one really bright spot in the number. And because that's a pretty big category, that just about offset the corporate tax decline. So the two canceled each other, and we got about a, kind of a net flat number for total tax collection.
So then what do you think payroll taxes could look like in the coming years? Is this a category that can keep growing?
I believe it is, and we will lose some ground in number of employees, I think. But what will offset that is I think wage growth will be better. We've talked again and again about the demographics and tight labor markets, and we saw even in last month's employment report, the one bright spot, at least if you're an employee, was that year-over-year hourly wage growth was at about 2.6%. And as bad as or as soft as the employment market may be, I think everybody still thinks it will grow at least 1%. So you add those two numbers together, and you're at a pretty healthy number there. You're more at the 3-4% level at least. So I'm not expecting a dramatic slowing. And then the other thing we'll have happening in payroll taxes is, again, while there won't be any COLA Social Security, we're going to have 2 years of catch-up in the maximum amount that can be taxed for Social Security. That's going to go up about $8,000 from about $118,000 to $126,000. So again, kind of September, October of next year, when a lot of people fall out of paying Social Security, there may be a little bit goose to the numbers at that time frame.
When you look at some other labor market data that we got this week that kind of supports that thesis of reasonably slow growth but still growth?
Yes, we did. We saw the job openings and labor turnover report, the acronym being JOLTS. And what that report showed is that there were fewer job openings than the previous month. Now, we saw a huge revision to the numbers for July, almost up to 5.9 million openings, which was kind of a high for the recovery. But we did see a big drop in the August data, which we received this week, and that dropped to 5.4 million openings, one of the larger drops that we've seen in openings. And it also depressed the year-over-year growth rate in jobs openings, which had been slowing for some time, which is actually more problematic to us. The kind of falling openings isn't necessarily dreadful month to month. But what's really important is what's happened to that growth rate. And it has come in for some time, which is usually consistent with slower employment growth 6 to 9 months out. So clearly it's not great news that the openings are slowing, but this is kind of unusual times. I mean, the openings have gotten so huge relative to hires that it really is kind of a problem. And in fact, the openings are still higher than the number of hires this month. There were about 5.4 million openings and 5.2 million hires. And the hires didn't fall off nearly as much as openings did. So that actually may say there's a little bit of matching going on out there, that finally supply and demand is kind of matching up a little better than it was. So that's a bright spot out of the JOLTS report, along with the number of quits still remained near a recovery high of about 2.1% of the workers quitting. And obviously if workers quit, they've got enough confidence that they're going to find another job. So that was certainly some decent news in the job openings report, too. And the number of unemployed compared to the number of openings was also relatively high or low yet. So that was good news, too.
Overall, then, when you look at fiscal 2017, would you expect the deficit to continue to creep higher, or are there signs that spending could come in more, that we could see some surprises on revenue?
Well, I think this year the Medicaid number won't be as big, and I think we probably passed in the last couple of years our big wave of Medicare, new Medicare people, and that will continue to be at a high level. But we may have hit the peak of the growth in that in the number of new Medicare enrollees, and so I would suspect that on the spending side we're probably okay. I think defense spending, it's hard to imagine it's going to go down a lot more than it already has. So we'll be okay there. The COLA adjustment on Social Security, again, will probably be relatively de minimis, so that won't hurt on the spending side. It will depend on the next Congress how we do on the other category. But for the first few months, obviously the budget's been set a stopgap measure at about where we were last year. So the first 3 months shouldn't be too bad, but we'll see what happens with the new Congress next year.
Bob, as always, thanks for your analysis today.
Thank you.
For Morningstar, I'm Jeremy Glazer. Thanks for watching.